Today we will continue with chapter 6. So this is the live lecture for chapter 6, part 2. I will post this link in addition to the first part in the chapter 6 folder. So last time we talked about internal controls, why they're important. We discussed some issues with fraud that companies have had in the past and are continuing to have in the present. We talked about the Sarbanes-Oxley Act. We talked about cash and the petty cash fund. So the lecture today will focus on one of the strongest internal controls over cash, the use of a bank. So last time we briefly looked at a bank statement and the basic functions of a bank. I just want to remind you that even though the bank is an external organization, the bank can be used as a control device because we are enhancing documentation procedures. We are enhancing safekeeping, asset safeguarding procedures by using a bank. So there are several common bank account controls that the company takes advantage of. We talked about using a signature card last time. We talked about deposit tickets. So by using a signature card, that signature card will show every authorized person's signature for a bank account. By using deposit ticket, the bank will show that the transaction is completed and the amount of each deposit. So again, the bank is a perfect control device in a way because it just prevents certain types of fraud to be committed. Last time we also talked about the bank statement and how today I'll teach you how to prepare a bank reconciliation or a comparison between the bank statement and what the company's accountants show on the company's books. So real quick, the bank statement, as you all well know, reports all the activity in a customer's bank account, just like your own bank accounts. So the company has not just one, but multiple bank accounts, and each one of their bank accounts will have a bank statement to be reconciled to the transactions that are reported on the company's books. So the bank statement, just like your own, it would show the account's beginning and ending balances, and then it will show all the ins and all the outs, all the transactions that are conducted through the bank account for the given period. So the company will receive the bank statement, they'll receive that document from the bank, and they'll know what the reported activity per the bank is. What our goal today will be to learn how to prepare bank reconciliation. We'll start with the bank statements account balance. We'll compare that to the books account balance. And you saw in the PowerPoint presentation last time that we will always start with different amounts. As we go through the bank reconciliation, we will make sure that we look at timing differences, that we look at errors, and we reconcile those timing differences and errors to the point to where we arrive at the same answer on both the bank side and the book side of the reconciliation. So I'm gonna start with my whiteboard. I want to show you what a bank reconciliation looks like, and then we'll switch over to Connect. So the bank reconciliation will look at what are the records, what is the cash account per bank, and what is the cash account per the company's books. So remember, this balance here comes from the bank statement. And this balance here comes from the company's general ledger. This is the cash account in the general ledger. So last time we talked about how these numbers, the balance per the bank and the balance per books, are not the same. I mentioned earlier timing differences and errors. So we'll need to adjust those balances and arrive at the same answer. So the bank reconciliation compares the two, and it explains the differences between the cash on the company's books right here and the bank's records. So there's certain things that we need to consider. I call those things time differences or timing differences. Those are differences that arise because of a time lag in recording those transactions. So let's say the company pays a bill and they write a check. That check will be reflected on the books of the company, but the bank will have no knowledge of that check being written until the check clears the bank. So here's a few more examples. Let's say a business deposits cash in the account. The business immediately adds the cash receipt to their checkbook into the cash account. However, the bank may take a day or two to add the deposits to the company's balance. Electronic funds transfers, electronic funds cash receipts are very often recorded by the bank first, and the company is the one that lags in their recording process. So the books and the bank statement will usually show those different cash balances because of the timing differences. So in order for the company to report cash at the correct level, they have to prepare the bank reconciliation, compare what they have on the books to the bank statement, and use that bank reconciliation to update the company's books and show the appropriate balance in the cash account on the balance sheet. The person who prepares the cash reconciliation should be a person who has absolutely no other cash duties. Remember, we talked about the principles of internal controls last time. The reconciler should not have access to cash or duties the journalized cash transactions, because if they do, they can manipulate the reconciliation to conceal any kind of fraudulent activity, any kind of theft. All right, so let's talk about some of the adjustments that we will be doing on the bank and the books side of the reconciliation. So the bank side of the reconciliation should always research or show or explore deposits in transit. So deposits in transit, this is an adjustment that would increase the bank side of the reconciliation. So deposits in transit, these are outstanding deposits. Those are recorded by the company, but not by the bank, not yet by the bank. Those should be added to the bank side of the reconciliation. Outstanding checks should be subtracted. These are checks that are issued by the company. They're recorded on the book side, but the bank has no knowledge of them just yet, and they have not been paid by the bank yet. So we will always add deposits in transit. We'll always subtract outstanding checks. The last reconciling item would be bank errors. So those bank errors would be either a decrease or an increase to the bank balance. So they could be a plus or a minus depending on what the error is. The errors are always recorded on the side of the reconciliation of the party that made the error. So that's why we'll report bank errors on the bank side of the reconciliation. If the business made the error, if the company made the error, then the reconciling item, the effect of the error, will be shown on the book side of the reconciliation. So these three things, deposits in transit, outstanding checks, and bank errors, should help us get to the correct balance. All right. On the book side of the reconciliation, we should see all the credit memos. Those are bank collections. Those are cash receipts that the bank has received and recorded, but the company has not recorded on the books. So credit memos will be an addition to the book side of the reconciliation. Electronic funds transfers, or AFTs, those will be recorded on the bank statement, but they will not be on the books. So we need to add or subtract depending on whether this is an addition or a subtraction to the company's balance. Debit memos, those are payments. Service charges will be subtracted. Interest revenue on a checking account, so interest revenue will be added. Non-sufficient funds checks will be subtracted. And I'm going to squeeze it down here. Book errors will be either subtracted or added depending on what the type of error is. So the book side, those are items that have not yet been recorded by the company on its books, but that have been recorded by the bank, and errors made by the company. So again, a credit memo here will increase the book's balance. A debit memo will decrease the book's balance, and the non-sufficient funds, or the NSF checks, they will decrease the balance. All right. So let's talk about, let's actually look at a bank reconciliation. I'm going to erase this, and then I will go to connect. So we will, let's do this. So I'll go back to Blackboard, chapter 6. I'm sorry, we'll go to McGraw-Hill Connect. Then we'll access the chapter 6 practice problems. Here's the student view. So this is what you guys should be seeing here. I'll go directly into chapter 6 and the in-class practice. There are a couple of problems here that you can attempt on your own. They're super simple, such as 6.1, internal control objectives. We're not going to spend time on those. Let me just find the ones that I wanted to work with you. The first one is, QS 6-7 bank reconciliation. These are the items that I just went over with you on the whiteboard. So here, this is just practicing what goes on which side of the bank reconciliation. So if we have interest on cash balance, the bank should be aware of that. The books or the company will be aware of that increase to the bank account when they get the bank statement. So on the reconciliation, we'll adjust the book side of the reconciliation, and that would be an addition. So interest that the bank collects on behalf of the company will increase the company's bank account. In addition to the bank reconciliation, we will have to prepare an adjusting journal entry to increase the cash account. So bank service charges, these will be reported on the bank statement. So on the reconciliation, we need to adjust the books. Any kind of bank service charge will decrease the book's balance. So we need to subtract it, and we need to prepare a journal entry to show the decrease of the balance. Minimum balance bank fee. Again, this will be reported on the bank statement, so we don't need to adjust the bank side of the account, the bank reconciliation. We need to adjust the books. Because this is decreasing the balance, we have to subtract it. And yes, prepare a journal entry to record it. Now, outstanding checks. Remember, outstanding checks, deposits in transit, non-sufficient checks, outstanding checks, deposits in transit, and bank errors are reported on the bank side of the reconciliation. I'm going to go ahead and find these items. So outstanding checks and deposits in transit will be both book. Outstanding checks will be a decrease because this is something that the company used to pay a bill. And we will have to just leave it alone. We're not going to prepare a journal entry because it is already reflected in the cash balance on the books. Outstanding deposits, these are deposits that the company has reflected in their balance, the bank hasn't. So we need to add them to the bank side of the reconciliation. There's no need to prepare a journal entry for items, and I'm sorry I changed this to books, but this should read bank. None of the items on the bank reconciliation on the bank side of it will require journal entries. So collection of notes by the bank, that would be an adjustment on the book side. We'll have to add that to the balance. And yes, a journal entry should be prepared. Non-sufficient funds checks reduce the book's balance. So subtract those, and a journal entry has to be prepared. So I was going pretty fast here, so I'm going to check my work just in case because okay, well they're all green. So all right. So the reason why I wanted to show you this film is because our next step is to actually prepare a bank reconciliation. So the bank reconciliation we'll work on is the next problem. So let's go to the next problem, bank reconciliation. And you'll notice the form, the bank reconciliation itself is completely blank. So we need to learn today how to read the problem and how to determine what are the correct amounts to put on the bank statement side and on the book statements, on the book side of the bank reconciliation. So this is the Nolan Company. Their cash account shows $22,352. This would be the book balance. The bank statement shows $21,332. This will be the bank balance. So right off the bat, you guys can see the discrepancy, right? on the company's books, the cash account is higher, over $22,000. On the bank statement, the balance is lower. So the whole point of the bank reconciliation is to find the timing differences, to find the errors, and reconcile those timing differences, arrive at the same answer on both sides. So this here is my starting point, this first sentence. I know that per the bank statement, the company has $21,332. However, the company's accountants, they state on the company's books, the balance of the cash account is $22,352. So we need to continue exploring, researching, reconciling those two numbers. All right. So you also notice that they separated the items that increase the beginning balances here and the items that decrease the balances. Again, remember from our discussion previously, there are only 3 things that change the bank statement balance. And those are deposits in transit. So that's an addition. Let's see if we have any deposits. Deposit as of June 30th. This is the first thing that changes the bank side of the reconciliation. The second thing is outstanding checks. Let's find the outstanding checks. And the third item that I had on the whiteboard were bank errors. So let's see the bank errors. Of course, we can't really decide if they are an addition or a subtraction before we actually read the information. So in this case, we have the outstanding checks are $3,713. I know that this is a subtraction from our previous discussion, 3,713. This reduces the adjusted bank balance. I can also, skim the rest of the information. I'm looking for deposits in transit. The second item is a service charge, so I know this is not affecting the bank side of the reconciliation. Third item is an error, but this error is something that most likely I need to account for on the book side, because the company's books, the companies are incorrect. The company's accountants have made the error. Then I have June 30th cash receipts were placed in the bank night depository after banking hours, and they were not recorded in the June bank statement. That right there tells me that these are the deposits in transit that are missing from the bank account. So these deposits, I'm going to add, this is $4,724. So at the end of the day, my adjusted bank balance is $22,343. Now look at the difference. I'm starting with $21,332. By adjusting for the timing differences, I have increased the bank balance to $22,343. So let's see what's happening on the book balance side. So I need to, again, go through the items. I know I don't have to worry about A because we already accounted for it. I know we don't have to worry about D because we already accounted for it. Let's look at the rest of them. The June 30th bank statement lists $41 in bank service charges. So remember from our discussion previously, what I had on the whiteboard is bank service charges always have to be taken away. So here's the $41 that we are deducting from the balance. For C, we have in reviewing the bank statement, a $90 check written by the company was mistakenly recorded on the company's books as $99. So here, because they mistakenly took away $9 more, we have to put that amount back. So this is the error, recording error. We need to put $9 back because the company's accountant has taken $9 too much out of the bank account. And then there is one more thing, transaction E. The bank statement included a $23 credit for interest earned. The company doesn't know that, so they need to add this interest earned. So all the timing differences are accounted for. When you guys are working bank reconciliations, you absolutely have to arrive at the same adjusted balance. So your adjusted balance per bank should be the exact same adjusted balance per books. And in this case, we were able to do that. All right. So let's talk about the next step. This is just the bank reconciliation. Once the company's accountant has prepared the bank reconciliation, we will look at this part only, the book side of the reconciliation. The book side of the reconciliation will require the company's accountants to prepare journal entries. So let's see how we will go about those journal entries. The whole point is, if you guys look at, I'll go back to my whiteboard. If you look at the T account for the cash balance, so this is the cash account, right? Before the reconciliation, in our cash balance, there was a balance of $22,352. However, due to all the changes required by the bank reconciliation, we should expect an adjusted balance of $22,343. So we need to increase this, to decrease this balance by a little bit. So how do we do that? Well, there were a couple of things here that we need to add. So we have the $9 increase because of error. The company has $23 interest earned increase. So the debits to this account should be $32 in total. And then on the credit side, we should see the bank service charges of $41. So let's look at the journal entries for items 1, 2, and 3. So for item 1, the $9, this is a recording error on a check. So this check was written by the company to pay some kind of a bill. So when the company writes a check, an account payable will be debited and cash will be credited. So in order to fix this error, we're going to have to debit cash $9 and credit accounts payable $9. For the second item, the $23 interest earned, we need to debit cash $23 and credit interest revenue $23. And for the last item, the $41, the bank service charges, we will debit some kind of a bank fee expense account, $41, and credit cash, $41. By doing that, here's item 3. These are items 1 and 2. Now we'll be reporting the correct balance on the bank account. All right. Do you guys have any questions about any of the material we covered today? All right. If you don't have any questions on this, I'm going to go ahead and share my screen again. And I'd like for us to go back to Blackboard. I'm going to pull up the PowerPoint presentation for Chapter 6, there is one more thing that we need to talk about as part of Chapter 6, and that would be the days sales in uncollected ratio. So let me just show you the ratio itself first. So I'm going to Chapter 6, Cash, Fraud, and Controls, and I will be looking at some of the last few slides in the PowerPoint presentation. So let me scroll down here a little bit. All right, here we go. So here is the days sales uncollected. This ratio shows us how much time is likely to pass before we receive our cash from credit sales. We also call this ratio days in sales receivable. For some reason I can't move. There you go. This ratio is computed by taking accounts receivable and dividing them by net sales. Once we are done with that, we can multiply that ratio by 365 days, and this will tell us how many days those accounts receivable stay uncollected. This ratio helps the company assess how quickly accounts receivable are collected. The company has to have something to compare this ratio to. So in this case, we are given two companies, Starbucks and Jack in the Box. I'm sorry, my mouse is not working perfectly well. So we're given two companies, Starbucks and Jack in the Box. Their days sales uncollected is computed for the current year, 1 year ago, and 2 years ago. So the first thing that we can do is we can just look at Starbucks. We can tell that 2 years ago, their accounts receivable in uncollected status were staying uncollected for 13.7 days. Then 1 year ago, that ratio improved, and now the ratio has deteriorated to 14.2. So I can tell that Starbucks is not doing well. I mean, their days uncollected is increasing. If I look at Jack in the Box, they're experiencing the same thing. 2 years ago, their account receivable were uncollected for 11 days. The current year, that number is up to 16.2. So Jack in the Box compared to itself is not doing well either. Out of the two companies, Starbucks seems to be doing better because they collect their account receivable on average 2 days quicker than Jack in the Box does. So let's go back to Connect now that we know how to calculate this ratio. We'll go to the next problem. Here's the next problem. We're given account receivable and net sales for 2 years. So to calculate the ratio, I'll take accounts receivable and then divide that number by net sales. That would give me the ratio, which I will multiply by 365 days. This will tell me how many days sales remain uncollected. So I can grab the information from up here. For year 1, I have accounts receivable of 100,000. For year 2, I have accounts receivable. I'm sorry, I think I'm doing this the opposite way, right? No, year 2, yeah, that's right. Year 2, 100,000. Year 1, 85,000. Oops. All right. Net sales for year 2 are 2,500,000, and then net sales for year 1 are just 2 million even. I'm still dividing by 365 days. So when I do that, we need to round to one decimal place. So when I make the calculation, 100,000 divided by 2.5 million times 365, I can see the rounded year two. It takes 14.5 days to collect the sales and receivable, and year one was 15.5. So the next question is, once you compute the ratio, the next question is the company's collection of receivables improving? And my answer would be yes, because we went from 15.5 days to 14.5 days. The company has decreased the collection of receivables by a whole day. This is the last thing that we're going to cover as part of chapter 6. I will, once this link is available, I'll post it in the chapter 6 folder. And you guys